At Arkwood Financial and Arkwood Benefits Consulting, Arkwood HR, as collectively as you all know us as Arkwood. We are independent organizations and companies. We specifically do not offer legal or tax advice. Our goal is to provide you information so that you can make decisions that are appropriate for you and your firms, which is why we have individuals like Matt and Dennis on the line. Because we like to reserve the legal and the tax work up to those professionals. So with that, I will turn it over to Mr. Hatfield, and Mr. Hatfield will start in on some of the changes that came up from the CCA, otherwise known as the Consolidated Appropriations Act of 2021.
So welcome, everyone. This is something that Pete and I have been talking about, taking bets on, as you know, over probably the last 3 to 4 months, that there would be some additional legislation in relation to PPP. I don't think any of us expected that it would be on December 27th of 2020 that it would officially get signed, but that is why we don't go to Vegas, or if we do, we lose. So there was a very large bill passed. As Pete mentioned, it's the Consolidated Appropriations Act of 2021. It is about 5,500, 5,600 pages. And just know that that bill contains every spending aspect of the government. So it is not just an SBA bill. It is a bill that has a lot of basically how the government runs. And they passed it to avoid basically the government shutdown. And they threw in the PPP stuff as well as some other items in there. So we're going to really talk about today the amendments or the changes to the PPP program. And as Pete mentioned, we're going to talk about the ERTC, which has a significant impact now on the PPP and loan forgiveness. So there's about, we're just going to walk through some bullet points here and I'll expand on them, but about roughly $285 billion in funding for original PPP loans or second round loans, which they're calling second draw. So one thing to note is that if a company did not take advantage of the first round of PPP funding and PPP loans, they can now get a loan under the original terms of the PPP program. There are different terms that will be required, companies will be required to meet for second draw, and we'll start talking about that. Pete, let's hit the first one.
Okay.
I think the biggest change or the biggest benefit in this particular legislation is number one, and I can't tell you how many updates I've read that completely misses this point, which tells me that I don't think people actually understood it. So I'll give you a brief history. When the original PPP loan program was developed and designed by Congress, it was always intended to not be taxable to organizations. Shortly after the PPP program was put out there, I'm going to say sometime April or May timeframe, Treasury came out and said, yes, the forgiveness of the PPP loan, should there be any, is not taxable in the revenue side, meaning you're not going to have to include that forgiveness in your income or your taxable income. If you use expenses, which to support forgiveness, those expenses will not be deductible for tax purposes, effectively making the PPP loan taxable. So if you had a $200,000 PPP loan, you use $200,000 of expenses, mostly payroll expenses, to support that forgiveness, you would exclude those $200,000 from your tax or from your expense deductions, if you will. And using a 40% tax rate, you would owe Uncle Sam $80,000 back at basically April 30th, whenever you pay taxes in 2021, sorry. That is what our all understanding was all the way up until November. This was a little Thanksgiving surprise that Treasury came out and said, we still stand by that decision. And not only are we standing by that, is even if you don't have your loan forgiven, but you expect it to be forgiven, you can't deduct those expenses in 2020. So we put out a communication to all our clients. They were not real happy about it. We expected it that effect to happen once a determination on forgiveness was made by the SBA, which many of you know won't be until sometime in 2021. But they basically made it effective in 2020. So companies were scrambling and knowing that they're going to have to cough up a big amount of money. Well, 12/27 of 20, the act completely reversed the Treasury's decision. And basically what that means is the forgiveness of the loan amount is not included in your taxable income, and the expenses used to support your loan forgiveness are still deductible by an organization. So effectively, you have no tax impact because of the PPP program. Pete, I know you want to say something on that.
Well, no, I mean, well, I guess I do, because sometimes I like to speak. But when I was reading up on that, I guess they had booked, what was it, like $160 billion or something like that to kind of absorb that deductibility of those expenses. So they, just from the first CARES Act go around, it seemed like they were expecting that this was going to be a part. It was already kind of budgeted. It was just, it was the language. Because if I remember correctly on the IRS side of things, this is just on the gift, right? Because if you receive a gift, you can't use those expenses that you.
That's what they were using as using
Right.
a gift as kind of in the. I will tell you, my tax department, our tax partner in charge, she's like, well, those shouldn't be deductible, you know? And she's like, it should be. So she thinks the tax theory of the way the Treasury standpoint all during 2020 was correct. She just like, this is an extra gift. This is a double dip.
Right.
So
it's a big, that's a big swing to the positive for us.
It is. My point always has been companies would have used those PPP loans, those funds differently had they known they were going to have to give back 40% of them next year. That was my point to her. So
this is just the expansion of the definitions.
I'm with you. Yeah, I'm like,
yeah. So when we're splitting up the 60/40 on the expenses that we're using to pay or to use for the forgiveness of the PPP loan, they just changed some of the definitions, which, well, I guess it could also change the dollar amounts that we're actually applying for, because in addition to the payroll and the rent and mortgage interest, et cetera, like that, they're now adding on the property damage expenses. So if your organization was impacted because of looting in the neighborhood, or if there's was it PPE and expenses to that, it's just clarifications that they're adding those definitions in as eligible expenses for the 40% side. And then on the 60% side, that was just, nobody really understood what group insurance meant from the first go around. Everyone was just kind of doing a baseline interpretation that I'm using my medical insurance. However, they did redefine it that it's going to be pretty much any benefit as an employer paid cost out to our plan participants. So their group insurance has been defined as the health insurance, dental insurance, vision, life, disability, as being an eligible payroll expense. So it's more of just kind of clarification.
Yeah, I agree. And now I see where the slide is coming from. And one thing I want to add on the 40% side, and what this is when you go to file for your loan forgiveness, you have to have at least 60% of your expenses that you're using to support, at least 60% fall under direct wages and these other wage-related expenses, meaning the group insurance. The 40% side, I did read something that if a company, let's say a restaurant made significant investments in redesigning their outdoor seating area, that could be used to support that 40%. So if they modified their facilities to an extent to allow them to stay in business, then they could use that in their 40%. So if you have that, I would look closely at that expanded definition on that 40%.
Was that restaurant specific, or is that just all industries?
I think it's all industries. Yeah,
Okay.
I believe that was all industries. Anything that you've done to retrofit your business to keep you in business, I would look at that definition. Yep. Cool. All right. So this is also a big one, the EIDL grant. So there's two parts of the EIDL. Basically, when you applied for an EIDL loan, the first thing you got, typically, although I've seen clients not get this, you would get an advance. And it was originally like $10,000, and then it was modified to $2,000 per employee. And I mean, it just kind of went through some reiterations, but it's up to about $10,000. And it was a grant that basically they gave you. Then the loan would come, 2, 3, 4 weeks later. You'll know if you got an EIDL grant or an EIDL loan, because when it's deposited into your bank account, it actually says SBH something, 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 and it comes directly from SBH. It does not come from a bank. Remember, PPP loans come from a bank. They are bank funds. EIDL grants and EIDL loans come from SBH. Well, when you apply for PPP loan forgiveness prior to 12/27, the grant amount you had to deduct from your PPP loan forgiveness. So for example, if you had a $100,000 PPP loan, you have all of your expenses in order for a full forgiveness. Your loan forgiveness application would literally say $100,000 eligible for forgiveness minus your $10,000 advance equals $90,000 forgiveness. And then you basically have to pay back the $10,000. What they did is they eliminated that need to pay back the grant. So it is now, it is free money, and it is not taxable either.
Cool. And the EIDL loans are back up and running, right? Because they got shut down for a little bit. But
they are back up and
refunded.
running. They are back up and running. They got refunded, more funds attributed to the program. So they are back up and running for a short time as well.
Cool.
All right. This is also an interesting one. So historically, when the PPP loan program first was launched, it was an 8-week covered period, meaning you had 8 weeks to spend the funds. Again, 60/40. Actually, originally it was 70/30, but they changed it to 60/40. And you had to spend it in the 8 weeks. And then everyone kind of got into a tizzy because remember, that's right at the time when a lot of businesses were shut down. Because basically the government shut them down. Think about gyms, think about restaurants, think about all these restaurants, all these businesses that were effectively shut down. And so what they were doing is companies, in order to get full forgiveness, they were paying their employees to basically sit and do nothing. The PPPFA in June said, okay, well, we're going to allow you to choose either an 8-week or a 24-week covered period. But if you choose the longer period, you're going to have to make sure and account for those employees all the way through your covered period. Meaning, if you have a reduction in FTE, you're going to lose forgiveness. And it's a formula that they calculate on the PPP forgiveness form, loan forgiveness application, I should say. Now, what the 1227 Act says is, a borrower can choose a covered period as short as 8 weeks or as long as 24 weeks. And so you can basically go through and figure out where you have effectively spent all of your PPP funds to justify full forgiveness and cut your covered period off at that point, as long as it's not more than 24 weeks. That's important because when you look at the FTE reduction calculation, you can then do whatever you need to do with your employee base after your covered period ends. Does that make sense, Pete?
It does.
All right. This was one we have been waiting for an awful long time, is loans under $150,000 forgiven. What we have been hearing was going to be an automatic forgiveness clause. Much to our dismay, it is not an automatic forgiveness clause. And I wish I could tell you I had all the answers on what what simplified application means, but we don't know that yet, because in the bill, the SBA has 24 days from 1227 to issue what that simplified application looks like. But here's everything that I do know about it. Is borrowers are going to have to make certain attestations that they complied with all of the parameters of the PPP loan program in order to justify full forgiveness. I don't know how a borrower will be able to make those attestations without going through the calculations And if it was me signing that, I would want to make sure I have the support. You don't have to submit the support, but I would want to make sure I know darn sure that I complied with the terms of the PPP loan forgiveness program before I signed that application.
Right. And this takes care of what, 84% of all loans that were issued?
Yeah,
I think,
it's in that
yeah.
neighborhood, 84, 86, something like that, something in that neighborhood.
Right. So it's a big number. So clearly the banks and the financial institutions, this is important for them as well, because now they can focus on, a much smaller percentage of all the loans as far as going through the forgiveness process.
Yes, it is a big deal. And I think ultimately it's going to be good for borrowers. But I think my word of caution is don't get tripped up and think this is automatic forgiveness. I've seen news sources say $150,000 automatic forgiven. I'm like, that is not
it
what
clearly
is.
states it. Yeah, it's a one-page application with specific requirements. So yeah, it is definitely not automated.
Yeah. I actually saw, it might have been something through the AICPA that talked about it. I'm like, that's just wrong. So which I do want to caution you, and Pete and I have been going through this a lot. You're going to get updates from everyone and their brother. And I'm not saying we've got it all nailed down. But I will say that I have seen a tremendous amount of misinformation out there. I don't know how that possibly can happen, because the bill is only 5,600 pages long. So I don't know how that can happen. But
you're very generous, sir.
But I mean, Pete, you saw one on ERTC. I mean, it's just wrong. So I'm hoping nothing in mine is wrong. It's been through probably 4 partner reviews, and I'd say most of us are pretty up to speed on what's going on in PPP. That doesn't mean that we've missed something. So I would just make sure and verify everything that is being said out there. And if there's something contrary, again, reach out to Pete. He can get to me, or you have my email address. Just say, hey, I saw something that says this. I'd be happy, because I like that stuff. I want to research it as well, because sometimes we may see it differently as well. But I think I've pretty much narrowed this one down, at least what's in here. Not to say that there's other stuff that I don't know about, because there's a lot I don't know about, but I think the stuff in here I do. So.
All right, let's talk about second draw loans and kind of define that for us, if you could.
Second draw. So that is the terminology in the exact bill. It is in the IFR that they actually released 2 IFRs. They released one, and they released
IFR
last
means
Wednesday.
Interim Final Ruling, just for all of us.
And right, thank you. And what that is, that's basically SBA's mechanism to clarify certain points that they want to bring forward to help borrowers. So they issued 2 IFRs last Wednesday night, which that is on the 10th day after the bill was signed, is what they were required to do. So they issued one that had a lot of terminology and clarification in relation to existing PPP loans, and they issued the second one, which deals with second draw. So let's hit the first bullet point. So in the past, it was 500 employees. Companies with 500 employees were eligible. And now it's down to 300 employees, companies that have 300 employees or less. And here is the kicker. A company has to have experienced a 25% drop in gross receipts, and I'll talk about that in a minute, for comparable 2019 quarter. We are talking about calendar quarter. I haven't seen anything to talk about fiscal quarter. If you're not on a fiscal, or if you're not on a calendar quarter, gross receipts, it actually says in the IFR that it's not specifically defined, and they basically made a reference to how the SBA's CFR is what they call it. That's their Bible, defines gross receipts. Here's the layman's terms. However your company pays taxes, if it's on a cash basis, it is gross cash receipts. If it's on an accrual basis, it's your gross revenue. And so you have to have a 25% drop in gross receipts. But no, it could be cash receipts or gross revenue, depending on how you pay taxes. And you only need to match that in one quarter. So if quarter one, you were up year over year, 2020 to compared to 2019, but quarter two, you were down year over year for that one quarter by 25% or more, you qualify. If you go back up in quarter 3 and quarter 4 and you're double what you were the previous year, you still qualify because you made it that one quarter.
So Matt, I'm getting a question. Is this a second loan that's on top of the first loan?
So it is a separate loan. This is a second, it's specifically called a second draw. So the first loan, you will have a loan document with the bank. The second draw, you will have a separate loan document with the bank. And so those two actually need to be kept separate. You will record in your books 2 different loans. It is not layered on top of the other one. You do not have to have forgiveness already filed for, determined, or anything else on the first one in order to qualify for your second one. What you do need to have done is you need to have exhausted all of your first round funds. You have to have spent all of those.
Okay.
Yep. Let's hit another point. So here's another difference. The first round was $10 million, up to $10 million. This one is up to $2 million. I am going to point in here that the whole second draw was really meant to help the hardest hit and the smallest companies, is really what they tried to do with the second draw loans. And so I think you're going to see some of these aspects come through when we start talking about these bullet points. It is 2.5 times in terms of how you calculate it. If you did your round 1, you will understand what the 2.5 times your average monthly payroll cost calculation is. And you can do it one of 2 ways. I can't imagine a company is going to use the first way, which is the 1 year period, the average month, 2.5 times the average monthly payroll cost for the 1 year period immediately prior to the date in which you file for the loan. I can't imagine a company would do that, because it basically right now, if you file in January, that means January 1 of 20 through 12/31 of 20, you would use that period. Making an assumption that companies probably were furloughing people or had lower employment costs than they did in 2019. Remember, the original loan was based on your calendar year 2019. So I'm assuming that most companies will pick up their calendar year 2019 average monthly payroll cost and use that as their basis to calculate their maximum loan amount, 2.5 times. Okay.
And this is a second loan, so therefore, and I'm just repeating it back just to make sure I'm understanding it. So let's say we got a loan for 2.5 times payroll that was paid to us in whatever, third quarter of last year, not been forgiven, but using the same 2019 data, I can now get a second loan on top of that. And as long as I've got expenses from the payroll and the rent and mortgages, interest, et cetera, like that, to support that second loan, then that too is going to be forgiven in addition to the first loan.
Yes, the forgiveness calculations are going to be independent of each other.
So effectively, I'm getting five times my average payroll expenses.
Yeah.
When I look at the combination of both of those loans.
Yep. One caveat, just to make sure, again, because of the expanded definition or the clarification of what your payroll costs are. Remember, payroll for health benefits, it's not just health, for the benefits, is you can make sure to include your medical, dental, vision, everything in that payroll. So if you didn't do that the first time, make sure you go back and do it. And you can still use 2019, but now know that it's going to be different than your original PPP application because of this expanded definition. You went back and added them to your cost to get a bigger amount.
Got it.
All right. So here's what they did in terms of hardest hit. Look at this. If you're in an accommodation and food service industry defined as an NAICS code, which is the code that's on your tax return as to what type of organization you are. If you're a 72XXX, I think there's 3 X's after that, you would actually qualify for not 2.5 times that average monthly payroll. You would actually qualify for 3.5 times that average monthly payroll. So restaurants, in fact, Pete, is there a slide on this? Did we do that? We didn't do this.
I didn't add that.
Okay, so there's a.
Thanks for pointing that out, Matt.
But they're basically, you can go in and you can just Google NAICS code 72 and you can see what industries all fall underneath that. Better way to see if you are in that industry, just go to your last tax return. It's listed right on your tax return to see if you qualify for that. Again, they're really trying to get money to those hardest hit industries.
So am I then going back and amending my first draw to go from the 2.5 to 3.5 times, and then doing my second draw at 3.5 times?
So 2 different loans. The original, we're only dealing with second draw loans. The original PPP provisions still apply to original PPP. All right. So like if someone's going to do a first round PPP loan, they can get up to $10 million still. Right. Because that's original terms. This applies, the 3.5 applies only to second draw loans.
Okay.
Yep.
Okay. So then this is probably a good comparison that we had put together just to kind of make sure that everybody was on the same page. But just to clarify what Matt just said is that we still do have an opportunity to do first draw. So if there is an organization that has not had the opportunity or has not completed a first draw loan, then those are still available for applications up until March 31st of 2021, which doesn't have that limitation. So it's a $10 million maximum versus the $2 million maximum. However, and it doesn't also have that 25% reduction in gross receipts. That's only applicable to the second draw, but it does include the additional medical, dental, life, vision, those types of expansions inside that first draw. Correct, Matt?
Correct. Yep. Okay. Yeah, this is a nice number. March 31st. Some people are saying, well, when will this start? I will tell you that the community banks, and for some that are the hardest hit industries right now, they actually opened the portal today. So I guess I probably shouldn't talk ill about the banks, but from our experience,
don't do that. We have no idea whose banking relationships people have. So
right, but I will say, talk to your banker and make sure they're participating in the program. They should be. Every banker that was participating in the original one should be participating in this one. If you had a problem through your bank, I think the community banks are a really good way to go. And I also think some of the e-banks the virtual banks are a really good way to go. You don't want to get locked out. I know a lot of companies, and I won't name the names of the banks, but they are very dissatisfied customers with certain banks because they got locked out by the bank. And I have helped clients into some of these other types of institutions, and they were able to get their loans very quickly. So I would, if you think you qualify for a second draw, man, I'd jump on this very quickly and make sure you're with the right institution.
Right.
Oh, we really have to cover this?
We have to go down this rabbit hole, yes.
So
this is why we record these, Matt, so people can go back and reflect on this.
Yeah, I will. I'm going to issue a caveat. There's no way in the short period of time that we have that we're going to be able to cover everything that has to do with ERTC. We're just not. And 4 of us partners, and I'll say 3 very, very smart tax partners, and I spent about 2 hours on this last week and to come up with some of this information that was here. I also sat through a 4-hour training class through the ASCPA, the Arizona State Society CPA, and a big portion of that was on ERTC. So there's a lot here. I think what you're gonna overall, before we get into the details, you need to see if you qualify for this. And so that's the first thing you're going to look at, is see if you qualify. And if you qualify, then I think you start, peeling the layers of the onion and start getting deeper and deeper into it, because you can get real deep. This is a rabbit hole that goes, halfway through Earth, basically, is how deep this thing can go. But the big changes, and this is why, Pete, you mentioned the top end of this. We didn't spend a lot of time originally on ERTC, and it was in the first CARES Act. But what they said is companies could either take advantage of the ERTC or they could take a PPP loan, but you couldn't do both. And the maximum amount of the ERTC was $10,000. Am I doing that right? No, I think it's $5,000.
$5,000.
$5,000 per employee. The 10,000 of wages, $5,000 per employee. And that's if they qualified. And basically the PPP loan was much more lucrative. And so we just kind of ignored the ERTC. What they did is they, in the 1227 bill, they actually created, they amended the 2020 ERTC to basically say, oh, you can actually have a PPP loan and you can take the ERTC if you qualify. That's the first thing they did for 2020 ERTC. And they added another ERTC for 2021. And we'll talk about those details. So what Pete has in here is this change is retro to 2020. That's absolutely correct. Is now for 2020, you can have the PPP loan and you can take your employee retention tax credit if you qualify. One thing to note, and this is really important. Well, we probably need to talk about how the ERTC is calculated to begin with. So, thank you. There we go. So it's up to it's really 50% of $10,000 in wages, up to $5,000 per employee. And to qualify, you have to show a 50% reduction in revenue year over year, 20 compared to 19. I don't know if we have that on here. I'm not sure if we have that on here, but basically to qualify. And once that quarter, if you qualify, then you start that calculation of the $10,000 in wages. All right. What's important, and that's the second bullet point on there, is those same wages that you're using to get your ERTC, you can't then take those same wages if they're in your PPP covered period. You can't take those same wages and say, oh, I'm going to use these wages to qualify for PPP loan forgiveness. That's basically double dipping on those wages. So the first thing I would do is look at your quarter over quarter gross receipts. And I'm going to say, just use that same definition of gross receipts, however you pay taxes, cash basis or accrual basis, and see if you have any quarter that is dropped by 50% or more. If you do, then determine, is that in your PPP cover period? Because it may not even be in your PP cover period. And if it's not, then you don't even have to worry about this wage thing that we're talking about, right? Because your PPP, your cover period is either, I'm guessing, well, before or after. It could be either before or after the quarter that you're using to get the up to $5,000 ERTC. I'm going to stop and see, Pete, do you have a question on 2020 before we move into the next bugaboo?
No, I mean, I think the only thing I would do is just kind of in our common dialogue is that really as an organization is we're looking back at 2020 and taking a snapshot at clearly our expenses. I know we do that, our revenue, because with this one, you do have to show reduction in gross receipts, just like you do for the second wave on the PPP loan. And if there's surplus wages that are not being identified to the PPP loan, then let's use those on the ERT, because we can get 50% of whatever those wages are, capped at $5,000 per employee. And so that can add up to, another, pretty healthy, dollar amount to help keep the organizations going that are absolutely being impacted by the pandemic. Is that fair?
Yeah, that's a very fair way to put it.
Because the PPP has already been taken, because that was always the biggest driver. Yeah.
And keep in mind that only 60% of your PPP funds need to be used in wages. So you might because a lot of my clients, and I've been helping them do loan forgiveness applications, because of the expanded 24-week period, we're like, let's just all use payroll. Payroll is the easiest thing. You don't have to go after rent. You don't have to go after all these other things. But now there might be a very real reason to go after rent and go after these other things. I will say, and we were very adamant, although I will say we had some healthy discussion amongst us partners. My view is don't file for forgiveness yet until we see what's coming out, if something comes out. if a company already filed for forgiveness and used 100% of their payroll, used it, basically to support the loan forgiveness with just payroll, and now they can go back and qualify for the ERTC, it's too late. They can't go back and refile a loan forgiveness application and make it 60-40 to be able to pull those 40% of wages over to ERTC. You're done. You've already filed it. You're basically out of luck. So
going forward, just to continue that specific example, then the only opportunity is to do it for 2021.
Unless if the company needs to, if the company doesn't have any other wages that they could use for ERTC for 20, you're right, they're done. They can't get it. Okay. So that is a nice segue into 2021. 2021 is a much more lucrative credit, and these are tax credits. And I'll tell you how they affect it in just a minute, but they are credits. This is not a loan. This is not something that you need to show how you paid something in order to support forgiveness. This is a tax credit. But 2021 is now, in order to qualify, you only need to show a 20% drop in revenue. I know these percentages are crazy. 25% for PPP second draw, 50% for ERTC 2020, and now a 20% drop for ERTC 2021. And it is per quarter, so it's Q1 of 21 back compared to Q1 of 2019. So you actually go backwards, not 21 compared to 20, but it's actually 21 compared to 19 to determine if you would qualify. All right. And then you would get 70%. I don't know what you're doing there. I see. Okay.
I'm trying to add it into the program.
I got it. And then there we go. I'm with you. I'm like, whoa. But basically, you now get up to $7,000 tax credit per employee per quarter. So for the first 2 quarters of 2021, you could get up to $14,000. All right. Right. Again, that's showing a 20% drop of 21 versus same quarter 19. Now, if you get a PPP second draw, this is where I think the wages is going to come into effect here. Is if you qualify for second draw, you're going to probably get that in the first 2 quarters, within the first 2 quarters of 2021, and have to spend those funds within the first 2 quarters of 2021, which is going to be competing with ERTC ERTC 2021. Right. That makes sense?
It does. However, it needs to be a part of the conversation. Yes. Because we skimmed over it last year purely just because it was disqualified. But now these are additional monies that are available. And, again, looking at revenue and expenses and how we're itemizing the expenses for the PPP forgiveness, this is additional monies now that are available to really all of our organizations that we work with. And so it just kind of needs to take a step back with the tax professionals and their advisors and say, okay, let's work through these numbers and let's make sure that we're not leaving money on the table. Right. Yep. I mean, that's a fair assessment.
That is a fair assessment. There are other updates, minor changes in the PPP. I highlighted the big ones in the PPP. I can't believe I'm saying. I would advise you to read the interim final rules if you want to. You
and I are going to read those things.
Yeah.
Everyone else is going to worry about creating revenue for their organizations.
That is true.
And then they're going to call us.
Then they'll call us, right? There's industry specific guidance that they have, especially like entertainment industry. There's very specific stuff in there to that.
There's specific itemizations for venues, correct? I think it's like right. They're isolating a specific amount of dollars for I think anything in the venue type of industry, any type of entertainment, concerts, event hosting, planning.
And the language,
to make sure that they're not running out of money for those individuals or those organizations.
Right. And I looked at, and the museums and stuff like that, I looked at some of those, so they could be not-for-profit venue centers as well that got shut down. And And I looked at some of that language, and they based it on reduction in ticket sales, right? I mean, it could be, gate sales or what have you. So if you're in that industry, that is definitely something you want to focus on. It is very clearly spelled out in the interim final rule, as well as the big bill, as to what happens. I didn't bring it to forward here because it's kind of narrowly defined. The other thing is 501c6s are also now eligible for PPP loans. They were excluded. So I know we have a client that is in the travel and tourism industry. And so they were excluded because they're a 501c6. They were excluded from the first round. They are now actually able to go back and get round one. They have to exhaust everything in round one. Once they do, if it's still open, then they could probably get a round two or a second draw, but I doubt that it's going to still be around for second draw. But just know that you can actually do that too. So.
Okay.